Hello, welcome to Cash Flow Webinar. Thank you so much for joining. All the people who are logging in and attending, I greatly appreciate that. This is the Cash Flow Club webinar, a cash flow club that we sponsor here at cashflowinvestingpro.com, where we go through the economic analysis of the underlying economy for the US as well as the global perspective to give us a backdrop before we dive into stocks that are yielding in this case, more than 10% free cash flow with limited debt, buying back shares, and growing both revenue and earnings. We want to unlock that potential for our club members, as well as talk through some of the attributes of the best investments we've picked to date in some of the previous cash flow webinars. We'll go through our current portfolio to see where we stack up relative to prior picks in those cash flow webinars and see how the portfolio is doing since then. All right, without further ado, let's dive right into the cash flow webinar and chat. It is June 8th, 2024. All right, first things first, always a disclosure, right? This is not financial advice. This is simply my opinion that I'm putting out there. Please absolutely seek professional financial health help from an advisor, from a financial professional. Study finance yourself, learn the underlying numbers, technologies, definitions. Prep yourself as much as possible and find a financial professional to assist you. This is simply advice. Excuse me, this is simply my opinion and not financial advice. A little bit about myself. My name is Cameron Stewart, CFA. I passed the Chartered Financial Designation back in 2012. I've worked in finance for over 20 years, both investment banking, where I helped take a company public, as well as corporate finance, where I'm currently the CFO for a private equity company. We no longer doing Orange Theory gyms. We're now doing med spas, so Botox, laser hair removal. We're building that out and bringing it from the East Coast of the United States over to the West Coast. But that's my day job in the at night. I kind of moonlight as a YouTuber and a value investor, and I want to teach people how to be value investors on their own. And I do this webinar and have the Cash Flow Club for people who want a little bit more one-on-one attention or some stock picks that I think are rather interesting. So here's a quote from Jay Powell. You'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too. So that's Jay Powell. This is about a year and a half or 2 years ago when I pulled this quote from one of our webinars, and I've maintained that this is a very interesting quote by him. He's saying, hey, we're going to be cutting long before we get to 2%. So the question is, where are we with inflation and how have we been doing? Well, as you can see from this chart, inflation has dropped for sure from the dramatic rise we saw leading up to 2022, and then the pullback here in 2024, excuse me, to 2023, but then a flat line of inflation in this 3.4%, and it's not going down, it's going sideways. So his quote of we're going to be lowering inflation, we're going to be lowering the Fed funds rate as we get closer to 2%. Well, we stopped coming down to 2%. So the idea that he's going to cut rates, I think, is getting further and further behind in the rearview mirror as we come to realize that the Fed funds rate that we have now at 5.5% is the long-term normal, and perhaps they don't cut rates. And that's precisely what's happening to the financial markets, is they are realizing that interest rates aren't coming down nearly as fast as they thought it was. If you can see this chart here, this is what the market thought rates were going to do in 2024. So in January, they were expecting six rate cuts in 2024. We've had zero so far. Now, what happens is the market currently expects two for the rest of the year. Well, we're in June now. We're halfway through. So they expect two more cuts, but inflation is not going down. So only if inflation comes down closer to 2% will we expect a rate cut. What's going to drive inflation down? Unemployment. So let's take a look at unemployment. This is actually the money supply. We'll get to unemployment in a second. So money supply has been growing the last year, which I think is going to surprise everyone. If I look out 10 years, money supply has grown dramatically over time. That's always been the 2% inflation mantra by the Fed. It's been this steady march upwards. Then COVID hit, you got a giant spike and a huge money print as we head to the tail end of COVID. Then what happened was the Fed raised interest rates, and they also, at the same time, reduced the money supply. This drop here is them lowering the money supply, which is restrictive monetary policy. They're tightening the money supply um, to cool inflation while they increase interest rates. And those are the two things they can do. They did them both at the same time to try and cool inflation. Um, and it worked to a point. But now what you're seeing is now, if I look at the last 12 months, I zoom out here, you can actually see money supply has actually grown. So what's happening is they are pausing rates now because they're no longer raising rates. And if they start printing again, which is what it looks like they're doing, that's actually monetary easing again. They are printing money to boost the economy, which is going to fly in the face of their 2% Fed interest rate target. So let's figure out what's going on in the economy. These are some quotes we're going to go through by various companies that are from Q4 of 2023. So last year's financials for these companies. And I want to call out why the economy was doing so well last year and why we did not have any rate cuts. So this is JP Morgan. The US economy continues to be resilient as customers still spending. That's JP Morgan calling the US consumer resilient. The way we see it, the customer is fine. Here is MasterCard. Rising wages is my comment here. You can see, let's start with the macroeconomic first, where we see both tailwinds and headwinds. First, the labor market remains strong with low unemployment and rising wages. These remain key drivers of consumer spending. Some risks we are monitoring include credit in availability and delinquency rates. This is saying that wages are rising. So even though we have inflation, that inflation is coming through in the form of higher wages, which is defending people's purchasing power, allowing the consumer to continue to spend. Here's Walmart. Food prices are lower than a year ago in places like eggs, apples, deli snacks, but higher in places like asparagus and blackberries. Dry goods and consumable categories like paper and cleaning supplies are up mid-single digits versus last year in the high teens or versus 2 years ago. So, so Walmart's even seeing slight food depreciation, declines in pricing, although in totality, food prices are up slightly with inflation. So let's take a look at credit card spending. This is payment volume and process transaction growth for Visa. Again, Q4 of 2023. The growth rate was above 8% leading into Q4, and then January dipped down. The drop is in a drop in a growth rate. It's not a drop in an actual transactions. It's just slowing down slightly. Same thing with payment volume. Payment volume was in the it's gonna be low single digits, 4, 5, 6%, and it's come down to about 2%, but it's still growing as of Q4. That is why the economy has been strong, and that is why unemployment's remained low, and therefore the Fed has not been able to cut interest rates. Here's some news from Uber and Lyft. Lyft said driver hours grew 47% year over year in Q4. Uber says supply trends continue to improve with active drivers up 30% year over year. And driver engagement, defined as the monthly supply of hours per driver, is up 10% year over year. So what is this saying? This was received as very good news for Lyft and Uber. It means the supply of drivers coming to the market has gone up. That's one way you read it. I tend to read it this way, that the only reason the supply of drivers is growing is that people need more money from their current jobs. They're working after hours in the gig economy to get some extra cash to keep up with their purchasing power from inflation, and their jobs, wages not rising as fast as they would like. So the squeezing of the customer, you can see this in growing default rates as people are starting to struggle as we get further down this path. I think this, which was read as a good sign for these companies, I think is actually a bit negative for the economy as people are trying to find other ways to earn a living. Optimization ended, demand continues. Optimization, that's a key word for layoffs. This is AWS, Microsoft, and Snowflake. I'll quote Snowflake here. Customer optimization returned to normal levels with 8 of 10 of our top accounts growing sequentially. Microsoft said the period of massive that period of massive, I'll call it optimization only, and no new workload starts, that I think has ended to this point. So what do we see is much more of the continuous cycle by our customers, both whether it comes to AI or whether it continues in traditional workload. AWS, we continue to see diminishing impact of cost optimization. The lion's share of cost optimization has happened. So these three behemoths are saying that people are returning back to big projects, that the optimization, the layoffs have stopped for now. And of course, NVIDIA, an absolute beast here. They're just saying tremendous demand for their product. We expect our next generation products to be supply constrained as demand far exceeds supply. So this is the underlying economy as we get into 2024. The customer is much stronger than people anticipated. It's taking a lot longer for the higher interest rates to truly impact customer spending. As a result, boom, the stock market is up. The PE ratio for the S&P 500 is 27.5 right now, an absolute huge number. And that's about 2 standard deviations away from the mean. So the valuation metrics that we can start seeing are at all-time highs or at the outer bounds of what is considered fair value. Same thing with the Schiller PE. That's just this 10-year earnings divided into the current price at 34.5. Again, basically 2 standard deviations away from the mean to the upside. And what's going on? Well, you can see the news from AWS, Microsoft, and Snowflake. The top companies, very few companies are registering earnings growth and power and return to spending, whereas the other companies are not doing as well. As a result, the stock market is focusing on fewer and fewer stocks, the ones that are receiving still the economic benefit. The other ones are not doing as well. This chart shows the market cap of the largest stocks relative to the 75th percentile, and it lines up beautifully with some of the other big peaks that we've seen historically: 2023, 2020, 19, 2000, even 1973. These are big, distorted markets. I think we're still in one, and I'll call it the indexation of money, where you have most people putting their money in the 401ks or in other index funds. Those index funds are passively managed. They manage to a formula. They're not doing actual analysis on the stocks. The SPY, the S&P 500 index, is a market cap weighted index. That means that the larger cap stocks get more of the allocation of money. And George Soros called this reflexivity in his book, where as a market cap grows or as a stock price grows, the investors who put money in take that as a sign that they were right. They put more money. The more money they put in, the higher the stock price goes, again, reinforcing the fact that they were correct, and the cycle continues. The same thing is true with the S&P 500 on a market cap weighted basis. The larger Apple gets, the larger NVIDIA gets, the more money is allocated from the S&P 500 into that stock, thereby lifting the stock price, making the market cap greater, and the cycle continues. This is what we're facing, and this cycle is turning into an absolute parabolic turn. I think now is the time to start looking at individual stocks and buying stocks at a reasonable price that can be defended and held for a long term. So why then Why is the economy doing so well? Well, one of the reasons we are not seeing the pullback that we expected when interest rates went from 0 to 5.5% is that the government is spending a tremendous amount of money. They spent $1.7 trillion of extra money last year. This black line here is a balanced budget. That's where tax revenues equal government expenditures. And you can see for the most of our history, the economy, the government lived on a balanced budget, with the exception of, like, say, World War II, when they spent a little bit more than the economy was generating. But for the most part, it's been an even keel. Recently, recently is in like the 1980s recently, but the growing trend, this is across political party, is spend, 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 and people will vote you into office because they want your money. Well, this is becoming increased. This spending is becoming more and more. And the Biden administration right now is spending to offset the tightening that the Fed is doing. So the Fed said, hey, inflation's high. I'm going to raise rates and I'm going to remove money supply. That is tightening for the economy. But if you're elected office, you don't want to be presiding over a recession. You don't want to be having people struggle while you're a president. So you will counteract the restrictive monetary policy with expansionary federal policy. That's what this is. This is expansionary federal policy by spending more than you take in, to the tune of $1.7 trillion to try and juice the economy to offset the tightening that Powell is doing. So there's a fighting between the two. Powell's trying to tighten to lower inflation, pull back the economy. Biden wants re-election, so he's slamming on the gas and he's trying to get money into the economy. So the two of them are fighting. This spending that they're doing is 6.2% of the total economy, which is a huge number, right? If GDP grew at, say, 2% last year, but you're spending 6% of the GDP is borrowed money, that means you're negatively contracting 4%. But for this spending, you have a negative 4% growth rate on your economy. So that's just an illustration, but you get the point. This is a massive amount of spending that they're doing. And as a result, the public debt is growing. We're at $34 trillion right now in total debt, and it's going faster and faster as they spend more and more. I saw this on TikTok, I thought, Twitter, excuse me. I thought it was very interesting how much debt accumulated so quickly. So this is showing that in the last 220 years, it's taken the U.S. economy to reach $11 trillion of debt, although it's only taken another 4 years to spend to 11 trillion in debt again. Kind of interesting to show how much more we're spending now than we used to. So here's that chart on unemployment I referenced earlier. You can see long term, this is 2015 to 2020, unemployment dipped down, pandemic happened, spiked, then it took a while for employment to come down, but it's come down. Below 4% unemployment is considered full employment, an economy that has full employment. And for the last couple of years, it's been less than 4, full employment, despite the rising interest rates, because the Biden administration and the federal government has spent more money to kind of keep the economy going. But that's starting to slow down. And you're seeing that if I zoom in a year, so this is 1 year of the unemployment rate, you can see that from 3.7, 3.5, call it 3.6 over, a couple month period of time, we're now 3.8, 3.9. It's going up. And I think that's going to continue. And you generally see a nice lift in unemployment right before a recession. This is the stimulus spending chart. So this is when the stimulus came out and everybody got checks. I remember seeing lines at the Rolex shop, at the Fendi bag stores. People were just spending this money like crazy. It boosted the economy. Some people lived up, some people saved it, other people spent it. But this is the cumulative savings during the pandemic. You can see it spike as people save the checks. And then as interest rates rise, as the economy has cooled, they have been living off that savings. And that's one reason you have not seen the pullback on spending that we would have expected with interest rates rising. You've got the federal government spending a lot, and you've got the consumer who had excess savings because of the pandemic. Well, that is now over. They now have negative savings. They've gone through all their COVID money, and now they are losing money every month. They are dipping into their credit cards. And now what's happening? We're seeing higher bankruptcies. If you look at this last year, this year through March of 2024, this is 4,670,000 bankruptcies in total, business and personal. That's up from 403,000. So what's that? 65,000 new bankruptcies. Well, the prior year, 395 to 402, that's like 8,000 bankruptcies. That's nothing. You go from 8,000 here to 60,000 next year. That's a big jump. It's not as high as the pandemic. We had 700,000 bankruptcies, but it's definitely a giant tick upwards, and I would expect that to continue. I thought this was an interesting chart. It's just the birth rates in the United States. This is going to be a weight on the GDP, right? The more labor you have, the more people you have. Labor is a function of GDP, right? Consumption, investment, consumption, government spending, net investment, and labor are the four components for the GDP formula. The more people you have, the more workforce, the higher your GDP. But if birth rate is below 2, your population is going to decline. And it's one reason you're seeing the Biden administration open up the border. Right or wrong, they're trying to bring people in to help boost the economy because those people are going to have to work. So where are we on the recession indicator? So this is the 10s minus the 3-year spread, called the 10 minus 2s, or 10, in this case, it's 10 minus 3s. And you can see every time it dips into the red, it precedes a recession. And the recession doesn't actually happen. If you look at this, it dips down, and then until it breaks back above the line, do you actually get the shaded recession area. So you get a dip, then it gets back above the line as things revert because of the recession, and then you get the recession. So it always follows the dip. So we're in this dip right now, and the dip has been delayed because the government's spending a lot of money. People had excess savings from their pandemic, so it's taking a little bit longer. But when you see this line start shooting back up above this red, a recession is around the corner. This is an indicator of what Wall Street thinks the odds of a recession are. Currently, 58% is the odds of a recession. That's also a very high marker. There's not often is the case that people believe a recession is coming. That definitely. Interest remains a huge piece of the overall expense of the federal government. It's going to continue that way. The Treasury interest payments astronomical. $1.7 trillion by April of 2025. That's going to weigh on how much spending they can do. And as I said before, this spending and the interest rate hikes are beginning to affect people. It takes time, right? We are a $34 trillion economy. It's a giant cruise ship. It's not a speedboat. It does not turn on the dime. It takes a long time, multiple years, for policy changes to be affected in the economy. And you're seeing credit card default rates slowly rise to record levels. This is the 100 largest, it excludes the 100 largest banks by asset size. So this is the small banks, the underbanked community, the people that generally have the biggest credit risk. You're seeing their default delinquency rates rise. Credit card default rates that are rising substantially. Not as high as the peak of 2008, but nowhere near as high before that. So it's definitely a divergence from what we would consider kind of a normal area. It's breaking higher like it broke for the great financial crisis. This is just overall U.S. credit delinquencies. It's higher, not what it used to be, pre-pandemic, as rates normalized. This is the ultra low rate environment held down delinquencies, but we're going to see that come back and normalize. So here is just the different segments of debt. Student loans, you can see the default rate or delinquency rate of student loans, an absolute crater here as the Biden administration um, uh, uh, like waived or what's the right word, canceled a lot of student debt. So the delinquency rates absolutely fell down. You can see you've got mortgages are very low because people refinance at ultra low rates. You've got credit cards and you've got auto loans that are creeping up on delinquency as the interest rates on those go up, and then as people lose their jobs or have financial difficulty, they can't afford those payments anymore, and they end up defaulting or become delinquent. But in terms of age, most of the delinquencies are sitting in this 18 to 29 or 30 to 39 range. You'd kind of expect that, but that's spiking first, much like it spiked pre-pandemic. So where does this leave us? I mean, long term, the markets do seem overbought relative to a super long-term trend like we see here with just S&P 500 relative consumer index, kind of this long-term trend. I remember there's a there's a Times front page. The page of the front of Times had a picture that said the equities market is dead. The death of equities, I think it was called. That happened in like 1980, right about here, which followed 10 years of market decline. So from 1970 to 1980, the market did nothing but go down or sideways. So you would buy what you thought was a cheap stock, and it just got cheaper and cheaper and cheaper. And to one point, the news media declared equity is dead. That you should not put your money in equities anymore. It needs to be a bond market. And of course, that was the low point, and it just ripped from 80s to 1999. So I think, we could be in for another cycle like that. So hold on to your hats. We have a tremendous amount of debt that we've accumulated. We are running out of ways in which we can juice the economy. We kind of pulled all the strings. At some point, that bill will come due, and you want to be prepared for that. No idea when that's going to happen or what you should do about it, but definitely want to be focusing on buying individual stocks. One person I like to follow is Howard Marks, who runs Oak Tree Capital. Howard has often said that while he does look at macroeconomic forecasts, he never puts any stock into them because it's too hard to fully understand all the complexities in the economy and forecast that. So while he'll look at it and he'll consider it, he always looks at fundamental analysis to drive his investment decisions. That's how he can find stocks and put money to work, even when the economy seems like it's a little shaky. It can always get shakier. So you just don't know what's going to happen. You can't time that kind of market. So the market is flashing some warning signs. If we just put up all the relative metrics, or a lot of them, you've got your trailing PE, your trailing gap PE, forward normalized PE, Schiller, price to book, price to EBITDA, trailing peg, price to cash flow, EV sales, all these. You look at the current valuations, you look at the averages, and most of them are anywhere from 13% to 80% over their average. I mean, above the average. And that is generally an indication of extreme market values. And if earnings were to take a dive because the consumer stops spending, because they lose their job, the savings evaporated, you're going to see market multiples come down and the stock price come down dramatically. So be very careful about that. Let's shift gears here and talk about home pricing. I know that you've seen home pricing, it's in the news. Well, this is pending home sales. It's absolutely cratered. That's absolutely true. This chart only goes back to 2002. However, showed charts in prior cash flow club webinars that go back 30 years where demand is at a 30-year low. Absolutely rock bottom demand. That is a time, as Warren Buffett says, you want to be greedy. Be greedy when people are fearful and be fearful when people are greedy. You might want to start taking a look at the housing market. It can take a while to bottom, but you might find some deals out there. If there's literally no one else shopping and someone has to sell the home, you step up and say, "Hey, here's a crazy offer." They might take it. You never know. Inventories are rising. You can see this giant run up in inventory leading up to the great financial crisis. We're kind of seeing the same movement. Inventory levels are absolutely at all-time highs. Great case for a drop in price. I'll remind you that it took 4 years for the price of real estate to come down to the bottom. So if you think it's over, it's probably going to take some more time. Median home sales prices are collapsing. I just said that. Here's an example. Austin, Texas, down 17%. New Orleans, down 11 or 12%. Boise, Idaho, 11%. A lot of these places, in my opinion, are work remote destinations. And I think that the work remote area is going to be under a lot of pressure, right? If you show up to an office every day and you work with a bunch of colleagues in that office, when budget cuts come around, it's much more difficult to fire someone when you're face to face with them. But if you work remote, you're on a Zoom call, it's a little easier. And I would guess that those people who have left and are working remotely will be the first on the chopping block. And that means that some of these remote destination places could see considerable price decline. Here's an example of Cape Coral, Florida. If you've seen these homes, they're like little mini mansions scattered throughout waterways in Florida where everyone's got a little boat dock and they can all like sit out and look at their pool or jump in your little boat and like kind of go around the harbor. Well, that's absolutely being crushed right now. Inventory is up 1,000% since 2001. And I would imagine price there is going to absolutely crater. So if you're looking for a vacation home, you want to move to Florida, you might want to start looking at Cape Coral, Florida for a beautiful home that you can pick up for a song here in another year, probably. But all this negative news, let's zoom out. I want to remind you that the United States is still has the greatest share of global gross domestic product, and that share is growing. I definitely think AI is a big player in that, not just for the NVIDIAs of the world that make the chips, but taking that technology and pushing it into enterprises will be able to streamline their workflows and things that even, food manufacturing, for example, anything is going to benefit from it. And perhaps the person making the shovels is not what you want to buy. Could be someone using the shovels to do something else. From a long-term perspective, the stock market has continued to go up. It should continue to go higher. We can quibble over if we're above this trend or not, but remember this S&P 500, the average has lots of stocks in it, and the stocks are mainly focused on a handful that are the very highly valued. There's lots of stocks in the S&P 500 that are very reasonably valued. So it does look like the big boys are getting all the play. So right here, we got small caps have gone basically sideways for some period of time. I do think that the PE ratio for the small caps has come down to 15.5. That seems cheap to me. I think there's an opportunity to look at the dispersion between the large caps and small caps. That's exactly what you're saying here. This is just the difference between the caps themselves on the forward PE basis. And you can see it's absolutely come way down the small caps versus large caps. As large caps get more and more overinflated and people forget about the small caps, I think is an area of opportunity. As I mentioned before, the market concentration in the big stocks, the Microsofts, the Apples, the Nvidias, which has crossed $3 trillion of value, these mega cap stocks are sucking in cash as more people want to join the bandwagon of this meteoric rise. At some point, it's going to end. And when it does, it's going to end very badly. Think of Cisco back in 2000. That stock absolutely cratered. And I think it's only now recovered something like 20 years later. So, and there's plenty of stocks in 2000 that were very popular that cratered and went out of business. So just because you think it's doing well, you might not want to jump on the bandwagon. Protect your cash, preserve your money, buy stocks that are cheap, that aren't betting on sales growth, because if it goes away, you're never going to get that money back. We can look at tech versus commodities. So as I said, I've said many times, the last 5 or so years, ESG, this environmental regulation, or this desire to put money to work into clean tech, has punished commodity companies that take a lot of oil and diesel to go mine copper and gold and zinc and lithium and all the hard metals that you need to run your daily life. I know that we all want to think we want to be clean, but we all can't be, Intuits of the world and have a software company. Some of us need to make cars, need to make steel, and that comes from something. So a lot of the ESG regulation has pushed money outside of the heavy asset commodity businesses and into tech because it meets an ESG score. And when people are allocating on their index funds, they're checking little boxes to say, hey, I want a clean tech company. I want companies that support renewable energy, which is great and all, but that takes money away from the hardworking assets that you need. You need to mine copper out of this ground. You need to mine cobalt, iron ore. All of those things absolutely need to be mined out, and the migration of money away from those hard assets have made those hard assets very, very cheap. And a lot of those companies have had to spend a lot of their resources to buying down debt and paying cash for assets for many, many years. And that's meaning that they're very cheap relative to the tech companies, which everybody wants to be part of. So I definitely think you should take a look at commodities. Here's just the S&P 500 relative in gold. We can see that gold price has increased a lot recently. And even though the stock market has gone up, gold price has moved too. So the net effect is basically flattening of S&P to gold as S&P just adjusts for inflation. It's not beating inflation in any way. The last couple of things I want to talk about is just this buybacks. We talk about the trifecta all the time, right? Earnings growth, share buyback, and market multiple expansion as being what gives you that hockey stick return. Well, here it's saying that buybacks in the S&P 500 have driven 27% of the return over the last many, many years. This is why we look for trifectas in the stock market. At the Cash Flow Club, I'm going to present a couple to you later today. And then finally, I just want to kind of recap that I've been hearing my entire life that oil is going to go away, that it will be replaced with renewable energy. Here's a forecast for energy usage going historically globally, and a forecast. And you can see oil, they're forecasting it to kind of flatline. Okay, maybe so. Coal is going to come down sharply, even though China is just signed off on this year to build 70 gigawatts of new coal power generation. You can see wind and solar is growing up dramatically. That's going to offset the drop in coal. I will tell you that I worked in the renewable energy space, building renewable energy projects, and the power contracts that they're signing for wind and renewable energy projects are higher than you can get for coal or for natural gas. That means that the price of electricity is going up. It's going to continue to go up because we're shifting away from cheap energy to more expensive energy. The first time in human history, we are going to move from cheap energy to expensive energy. It's always been reversed. You find the cheaper and cheaper energy as the economy takes off and requires more. We are now going in the opposite direction. That's going to add to inflation going forward. All right, let's check out the Cash Flow Club picks. I just like this image of Powell going burr with the printing machine. I hope that we have stock picks that are going to go burr with the cash dividends and the cash flow. But I'll cut it here for the public version. I'll save the rest of this version for the actual Cash Flow Club members as we go through our existing portfolio, how we've been doing, and some new amazing picks for the coming year.